Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 21 of 2026, and this week brought the strongest reopening signal we have seen since the war began.
3 supertankers transited the Strait of Hormuz, the first such crossing since March, while President Trump said the United States was in the final stages of talks with Iran.
That is a major shift from last week's stalemate.
It is, and the market reacted quickly. Brent crude fell more than 5% on May 20th, down to around $105 per barrel, while WTI moved below $100.
So the passage may be starting to open,
It may be, but the bigger question for ship recycling is whether it opens in time.
and that answer still looks like no.
Right, the diplomatic signal is stronger, but the operational window is almost closed. The subcontinent now has roughly 1 week before the practical monsoon slowdown begins.
Which means that even if Hormuz continues to reopen, there may not be enough time for owners to make recycling decisions, negotiate deals, complete logistics, and beach vessels before the window shuts.
That's the central point this week. Passage opens, window closes.
And even the oil market is not treating this as a full reset yet.
Correct. ADNOC CEO warned that full recovery in Middle Eastern oil flows may not happen before late 2027. That follows a similar longer-term warning from Saudi Aramco last week.
OPEC also cut its 2026 global demand growth forecast, citing the conflict's impact on trade flows.
And OPEC Plus output fell sharply in April. So yes, the diplomatic motion has re-accelerated, but the supply position has not recovered yet.
That distinction is important. We have a better political signal, but not yet a normal physical market.
And freight is telling the same story. The Baltic Dry Index consolidated, but it did not collapse. It closed around 3,005 after peaking above 3,090 earlier in the week.
Capesize earnings eased from last week's highs, but they are still above $40,000 per day.
And Panamax was the standout. Earnings moved higher through the week, reaching more than $22,000 per day.
So for owners of older dry bulk vessels, the earnings argument still favors trading over recycling.
Precisely. Freight is no longer accelerating the way it did in weeks 19 and 20, but it remains strong enough to keep older ships active.
Which means the supply backlog remains in place.
Let's move into the recycling destinations, starting with Bangladesh.
Bangladesh remains one of the more stable stories in the market this week.
The taka continues to hold within its established Q2 range, around 122.87 against the dollar. That stability has been impressive, especially against the backdrop of the Indian rupee and Turkish lira, both breaking to new lows.
And Bangladesh's April inflation print finally came in.
It did. April CPI rose to 9.04% from 8.71% in March. Non-food inflation also increased, with transport and housing utilities reflecting the pass-through from the war and energy shock.
But compared with Pakistan and Turkey, the increase was contained.
That is the key takeaway. Pakistan's April CPI was 10.9%, and Turkey's was above 32%. Bangladesh did feel the shock, but taka stability appears to have limited the damage.
On the recycling side, local steel plate prices softened to roughly $543 to $549 per ton.
That reflects some mill-level easing after Brent pulled back, but Bangladesh still remains well ahead of India and Turkey on price.
And the letter of credit pipeline continues to function.
Yes, the LC pipeline has now maintained its cleared operational status for a 6th consecutive week. Cash buyers in Chattogram are still reporting file-to-fund cycles much shorter than what we saw back in February.
So Bangladesh has demand, financing, and operational readiness.
It does, but the missing piece is still tonnage. The yards want ships, but owners are still holding them.
So Chattogram is active operationally.
Active, yes, but the broader market issue remains unchanged. The number of recycling candidates entering the market is still not enough to relieve the backlog before monsoon.
Moving to India, the rupee was the headline again.
Absolutely. The Indian rupee broke decisively above 96 and touched a fresh all-time low, around 96.97 against the dollar.
That is a major move.
It is, especially because the Brent pullback and Hormuz crossing headlines did not produce a meaningful rupee recovery.
Which suggests the currency market is not convinced that near-term normalization is here.
That's right. The rupee appears to be pricing a longer import bill shock, not a quick diplomatic solution.
But India's inflation picture was surprisingly calm.
Very calm compared with the rest of the basin. India's April CPI printed at 3.48%, up only slightly from March and still comfortably inside the RBI's 2 to 6% tolerance band.
So the currency is under pressure, but domestic inflation remains controlled.
That's the interesting divergence. The price level is calm, but the currency is telling a much harder story.
And along pricing softened further.
Local steel plate prices traded around $400 to $408 per ton in dollar terms, keeping India as the lowest price destination in the subcontinent.
That widens the gap with Pakistan sharply.
Yes, Pakistan's steel equivalent is around $700 per ton, so the gap to India has widened to roughly $285 per LDT.
India still has the compliance advantage, though.
Very much so. More than 110 yards in along continue to hold valid statements of compliance, which remains India's strongest structural differentiator.
But compliance alone does not create supply.
Correct. The rupee breaking 96.97 did not release tonnage, CPI stability did not release tonnage, and the supertanker crossings did not release tonnage either.
Pakistan, meanwhile, continues to look surprisingly firm.
Pakistan has extended the unusual configuration we saw last week. While the Indian rupee and Turkish lira made fresh lows, the Pakistani rupee held almost unchanged around 278.63 against the dollar.
So Pakistan is now the only subcontinent currency that has not made a new low since the early April ceasefire.
Correct. And on a year-to-date basis, the Pakistani rupee has actually strengthened against the dollar.
The state bank's 100 basis point rate hike seems to be working.
That appears to be the case. 2 weeks into the post-hike period, the FX transmission looks supportive rather than destabilizing.
Pakistan still has the inflation issue, though.
It does. April CPI at 10.9% remains a serious concern. And the May print will be important, especially because Pakistan's oil import bill has been under heavy pressure.
But from a recycling perspective, Gadani's pricing looks very strong.
Very strong. Local steel plate prices held at 195,000 rupees per ton, which translates to around $700 per ton in dollar terms.
That keeps Gadani in the strongest absolute pricing position of the year.
And it consolidates Pakistan's structural position. The Gulf proximity premium is still relevant, the currency is anchored, and 3 HKC certified yards remain operational.
But again, the same limitation applies.
Yes, the candidate pool has not arrived in sufficient volume. Pricing strength is real, but it has not yet produced a meaningful inflow of recycling tonnage.
Finally, Turkey.
Turkey remains in a separate market. The lira broke again, reaching around 45.58 against the dollar.
Another record low.
Another record, the Central Bank of Turkey still appears focused on preventing disorderly depreciation rather than defending a specific level.
And inflation remains locked in.
April CPI at 32.37% continues to define the picture. The earlier disinflation narrative has clearly ended, and independent estimates remain materially higher than the official series.
How does that translate into recycling?
Aliaga remains structurally uncompetitive for mainstream tonnage. Prices are still around $268 to $290 per LDT, depending on vessel type. Turkey's role remains limited to EU-regulated tonnage, where compliance and Basel Convention requirements matter more than headline price.
So the broader market conclusion is fairly clear?
It is. This week brought the strongest sign yet that passage through Hormuz may be reopening. Tankers crossed, Brent eased, diplomacy accelerated.
But the recycling market did not receive the one thing it needed most.
Tonnage.
And with only about 1 week left before the practical monsoon closure, the timing is now the decisive factor.
The freight market is still strong enough to keep vessels trading. Currencies remain volatile. Inflation is uneven across the basin. And buyers are still dealing with a market where demand exists, but supply does not.
So in one line, the passage may open, but the window will not.
That's the story of week 21.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
Until then, stay safe.
And see you next week.